Is there on ITC. Let's connect right back with Vetri Subramaniam and Dipesh Agarwal on their latest report from UTI AMC on the Super Capex Cycle. And what do you think, Vetri, have been some of the key findings? When can we see the next big Super Capex Cycle play out in India?
See, certainly when we compare with the last cycle, there is a key difference is the starting point. Last time in FY3, your capex to GDP was 23.7. Now we are already at a 29.3. Certainly with higher capex to GDP, the probability of a growing capex at a higher pace becomes difficult. In terms of key sectors, when we look at last time, that it was a global commodity and the global demand cycle, our exports double, our profitability of Indian metals and Indian oil and gas company improved substantially. Even on the domestic front, when we look at last time, there was an expansion of the telecom coverage network, and the government opened up the key sectors like road and power generation for the private sector. When we look at the current situation, none of these sectors are anywhere close to where they were in FY3. So it seems like we need to wait a bit for the next Super Capex cycle.
You know, one of the key things, Vetri, in the previous super cycle was the real estate prices continuously going up, the sort of construction activity that you were seeing. You think that is nowhere under the recovery, and that was one of the important factors?
So if you actually look at the Super Capex cycle, that was actually 2003-2008, driven more by private capex, not necessarily by real estate. Looking ahead, could real estate be one of the drivers of the next Super Capex cycle? Possible, though, you know, I think currently it's a sector which is plagued with multiple issues stemming from credit-related problems, the transition to RERA. But you have to presume that given most data indicates that there is a aggregate deficit, though micro-market situations might look different, that is an area which could help drive the next Capex cycle. Also, you know, just to be careful about the use of that term Super Capex cycle, I think the big point we made with this white paper which Dipesh authored was really to say that even the last 3 years have actually seen well above trend growth rate in Capex. The problem which most participants are experiencing is that they're trying to benchmark the growth in Capex to what may well have been a once-in-a-lifetime trend of 2003-2008, when real Capex growth averaged almost 16.5% real CAGR. And in the last 3 years, it's been about 9.2% CAGR, well above the historical range, but obviously not comparable to that Super Capex cycle. So I think the problem with the disappointment with the investment cycle is really the fact that we are comparing it to the wrong benchmark.
Right. You know, when we just look at the interest rate, Dipesh, how big a differentiator is that? Because interest rates are almost at a low, and IRR of projects may be workable. How important do you think this low interest rate is if the cycle had to start once again?
See, if there is no demand for your product, even the benefits of lower interest rates or even lower tax rate will be passed on, and you will be back to the old IRR assumption. The key important thing is demand. Which businessman will set up a factory if there is no demand supply in his favor?
Vetri, just wanted to talk a little bit about one of the points that have been mentioned in the report about opening up of some of the heavyweight sectors into private investments such as power, road development, etc. What kind of potential does that hold in the overall cycle of capex picking up?
So actually power is one of the pain points from the previous cycle. Because whereas we have allowed the private sector to come into power generation, the reform agenda is sort of still unfinished. And therefore, it's not clear to me that you can really make power a driver of the next Capex cycle. In fact, if you can resolve some of the issues in the power sector, that might actually bring relief. strengthen entrepreneur balance sheets, give the banks a little bit more risk appetite again, and so it's more repair work as far as PAR is concerned. Roads, we're continuing to do reasonably well over the last 5 years, but it's not something which can really give you a step up. So again, just to go back, the areas where there is potential, clearly real estate, railways and transportation infrastructure in general could be an area which is opened up further to the private sector, and that could drive investment. And the third area, which again we are trying to implement some policies, and I would say the headline tax rate cut which was made just about 10 days ago to sort of attract more FDI into India, to make it a manufacturing destination for the things that we are still importing. And when you look at our import bill, what gains a lot of attention and disproportionate attention is oil prices, whereas the reality is that as Indian income levels have gone up, the biggest pain point in our trade deficit is increasingly electronics. And therefore, I think, you can actually kill two birds with one stone if you actually get a large amount of FDI coming into India for electronics manufacturing. It would not only bring in FDI, but also help address a critical issue as far as the trade deficit is concerned. So these are three areas where certainly the government can do a lot more in terms of enabling.
Important market question. Are market participants, earnings on the street, overall consensus earning, factoring in a recovery in capex?
No, I don't think at this point of time anybody is budgeting for a significant improvement in capex. There is obviously some increase in earnings estimates because of the corporate tax cut-in rates that we got about 10 days ago. But I think it's the cut in corporate tax rates is a building block, simply because it leaves money in the hands of businesses, and it is businesses which take the decision on where to invest, who and how many to hire, and what kind of products and services do they actually want to manufacture and sell to customers, and put in place a branding and distribution system. So by leaving more money with the producers, you're giving them that optionality of determining how they want to use this additional resources. And I think that's an important part of the equation for us to drive capex in the economy, because I think capital in the hands of businesses and entrepreneurs is likely to be far more productive than capital in the hands of businesses. So it's an enabling mechanism. Again, to repeat, the health of capex trends is actually quite good. If you look at our capex to GDP, as Dipesh said earlier, it's significantly higher than where we were in 2003. So we are doing reasonably well. We'd like to do better. I think leaving more money with entrepreneurs is hopefully something that can help this cycle go up further in the days ahead.
Right. Vetri, we've not had a chance to interact with you post tax cuts. How important are they in terms of savings for companies, and how important is that for capital of banks and probably capex of a lot of large companies?
Certainly important. I mean, the government has put out an estimate of about $20 billion, though there's some debate about whether that was the actual benefit or it is smaller. But it is a significant benefit. I think the key issue is, as I said, this means that the government's takeaway of pre-tax profit comes down. You're leaving money with the entrepreneurs. They get to determine whether they want to invest in new facilities, they want to hire more people, they want to create new products and services which might involve R&D, innovation, branding, distribution, and I think therefore it's a very strong enabling factor. But it is not sufficient by itself to turn things around for two reasons. One, what the economy is currently experiencing is actually a problem on the demand side. The economy is also facing stresses as far as credit is concerned, which has clogged up the markets. There's a trust deficit in the markets, and to that extent credit is not reaching people who actually need it. And I don't think these issues are actually addressed by the tax rate cut, and therefore there will need to be some continued tinkering around with policies as regards credit, freeing up of markets. We've got the RBI policy today. Let's see if there is any thought process from the central bank in terms of what they can do to clean up the credit markets. There's been discussion about doing an AQR for some of the entities. There's been talk of needing to put in place a much speedier system for resolution of distressed non-bank financial companies. It's been more than a year since we've had one or two entities go into problem, and I honestly think it is taking too long for us to resolve some of these problems, and that just results in cholesterol building up within the system.
Vetri, Dipesh, thanks so much for taking our time for us. Always good to get perspective from you. That was, of course, one of the big reports in Capex cycle, and also talking about the recent changes that have happened in the tax front. But RBI